What's going on, guys? It's Chris here with Retail Algo Trader. The date is September 18th, and this is going to be a real-time overview for the week of September 18th through the 21st. We'll be using a simulated account to simply annotate the trades we're actively taking, as well as the process of building the trade, and to demonstrate the risk-reward associated with these trades. All trades will be conducted with a single contract per strike to show the value of profit and loss per contract. Before we look at this week's trades, let's take a look at last week's trades. Hey guys, today's Friday, September 13th, 2018. And this is Apple. This is the call spread that we entered earlier in the week with the 227.5. Price is currently sitting around 227.5. It went in the money a couple minutes ago, so we're bouncing back and forth between in the money. Just since we're so high up near where we shorted our call, risking going in the money and closing in the money, we're going to basically turn this into an iron condor by adding a put spread on the lower side. So what we'll do is we'll bring the options chain over, and we're going to look to add a put spread of something that'll give us roughly 80% probability of out the money. So if we look at probability out the money, we're looking at around 220 or 222.5, which is 36 cents right here. And we can go with the 220, which is 19. So if we do that, we'll sell the 222.5 and we will buy the 220 for 19. The difference there is 35 to 19, so you're looking at about $16 credit. We'll try to get filled right at 15. Put a limit order in and submit. And we got order filled. You can see right here. We'll go to our manage tab, double check. Yep, we got order filled at 15. Alright, so that will basically give us, now you see down here we got filled, and that'll basically give us the 222.5 protection against our 227.5. So now instead of just being in a vertical, now we have the lower side protection, 222.5. And now that's the range. As long as we stay, we just added $15 credit to our play, and we just need to stay above 222.5, which is pretty likely. And now this can bounce around, and it can possibly go a little in the money. We'll try to close it out before letting it expire, but at least we have some bottom side protection now to kind of hedge against that if it does start to go in the money and we start to take some type of a loss. But we'll close out the position if it looks like it's not, coming back down. All right, we'll see you when we close these positions out. All right, hey guys, what's going on? Today is Saturday, September 15th, 2018. We're going to look at last week's trades before we go into this current week's trades coming up here. Top left up here, we have MU Micron Tech, and we had an iron condor going into that play with a 47.5, 42.5 range. We did spike below it, but it never really gave any indication that it was going to continue to flush down, so we never adjusted the trade, and it came right back up, and we ended up closing out the money for the full credit of, let's see, it was $9. If you traded one contract, it was $9 with a $41 max risk, so about 22% return on your money that you risked. Bottom left here, we had MO. MO was a put spread of 59.5, 59. We had a huge spike up that helped us out. Not sure what that spike was all about. Never really looked into it. Don't really care. All I know is that it helped us out significantly. Spiked up, dropped down, hung out for a while, and just sort of rallied up into Friday's close. With that, we collected full premium as well, being that it closed out of the money with $8 if you traded one contract with a $42 max risk for a 20% return on your money. And then we go to the top right up here with QQQ. QQQ was an iron condor with a 184.5, 177.5 range. We did spike to the top side of QQQ's range, but it never really gave any indication of continuing to rip up. And we were watching Tech. Tech had some good news, but nothing crazy to the point where this was going to continue ripping up. So we never ended up adjusting that trade, just because we hung out at the top here and we were just waiting for it to come back down. It did come back down and close out of the money, and we collected full premium on QQQ, which was $11 if you traded one contract for a $39 max risk, which ended up being a 34% return on your money. And last trade was Apple. Apple down here on the bottom right. Apple was initially a call spread of a 227.5. That was the top side of our call spread with a 230 that we bought. That call spread did end up going um, in the money. You see it spiked, and we did end up going in the money. We did end up adjusting that trade. We turned it into an iron condor by buying the 222.5, 220. We bought another vertical, so we turned that vertical into a iron condor. Basically, what ended up happening was it spiked up. We bought right around here is where we bought our low side protection, and then it kind of spiked down and hovered right around there. We ended up closing out of the money for full premium on that play as well. Initially, I believe it was about $18 we were expecting, and with the added um, bottom side here, with the added put spread, we ended up getting $34 per contract, or not per contract, but per spread. If you traded one contract, it was $34 with a $216 max risk for a 15% return on your money. Now, all in all, we took in $62 of credit. We risked $338. That was the max risk, and it ended up being an overall between the four plays an 18% return on all the money risked. So within a couple days, about 4 or 5 days, we ended up making 18% return on our money that we risked. So that was last week's trades. Stay tuned for the coming week's trades. My name is Chris. Have a good day. All right, hey, what's going on, guys? Today's September 18th. It's Tuesday. All the trades we're going to be looking at is going to be Friday's expiration, so September 21st. It is about 4 days, 3 to 4 days out. We're going to be looking at EWZ, MU, Netflix, and QQQ. Here is EWZ, and we have on our pop flop indicator, we have a compression point indicating there's going to be a break in a up or down direction. And we just got today a up direction. So that is bullish. We're going to be looking to sell a put spread. So we'll bring up our options chain here. And the put spread we're going to be looking at is the 31.531, which will give us about 80% probability of out the money. So we're going to be looking to sell the 31.5. And we're going to be looking to buy the 31, and that'll give us $7 of credit on a $50 strike difference. Now, when we add that, we take away the credit that we took in. We have a $43 max risk, and we take the credit that we took in of 7 against the $43 max risk. We're looking at a 16% return on our money if everything goes as planned. All right, so we'll go ahead and enter that trade. The difference here is 18 and 11, so we're looking at about 7. So we'll set our credit limit order to about 7, and we'll go ahead and place the order. And we immediately got order filled. You can see quantities updated. We'll check our manage tab, and we are in the trade. All right, now we're going to be looking at the next trade. All right, so we're looking at MU Micron Tech. Micron Tech reports earnings September 20th, so this coming Thursday in 2 days. We will not be entering this trade until Thursday. They report after hours, so we're going to be looking to get as close to the earnings report as we can. That way we don't risk, it going either direction in anticipation for the earnings report. So we'll be entering MU sometime around midday on Thursday. We'll be looking to do an iron condor with this play just because it's an earnings report and you never know which way it's going to go. So we'll be doing a iron condor trying to keep about 80% or more probability of out the money. We'll probably look to do somewhere around $47 to $49 on the top side and somewhere around $39 to $38 on the bottom side. So stay tuned for that play. We'll be posting that video in a couple days. All right, next one we're going to be looking at is Netflix, NFLX. Netflix does not report earnings. There's no catalyst that we're expecting, but they do have a decently high IVP at 74%, meaning that over the last year, implied volatility has been 74% lower than it is right now. So we're going to look to capitalize on that. I don't see any directional indication, so we're going to be looking to do an iron condor on this play. So we'll pull up our options chain here, and we'll bring it up to Netflix. which I don't have recently. All right, here we go. Loading. And there we have it. We're going to be looking at probably the 340 to 337.5 is what I was looking at earlier. So let's take a look and see what we got going on there now. All right, so the 340 to 337.5 will give us around a little bit over 80% probability of out the money. When we take a look at our rangefinder tool, that gives us well over the 95% probability mark. Or sorry, we look down, it'll give us right around our 70% probability mark. So we'll be looking to do that one. So we'll go ahead and we'll select to sell the 340 and we'll buy the 337.5, and that's a $250 spread difference with about a $11 or so credit that will be taken in. So we'll come down to the top side, and for the top side we'll be looking to do around a 380 to 382.5. So we'll take a look at those premiums, and that's about a $5 credit. When I was looking at it earlier, it's slightly higher. We'll go down a little bit and see what we can get with around 80% probability of out the money. So if we look down a little bit, we got the 370 and 372.5 will give us right around 80% probability of out the money. We'll try to snake it a little higher. If we go with the 372.5, 375, which is roughly about $15 or so out the money, or about $12 to $13 out the money. And we only got 2 or 3 days left. That should be plenty of time to stay out the money. With 372.5 and 375, we'll look to take in a pretty decent amount of credit. So we'll go ahead and we'll sell the 372.5 and buy the 375. All right, so if we look to get into this trade, we need to check and see what our differences are between our bid and ask. So we have 81 and 68, which is about a $13 difference on the put side. And then we go down to the call side, and we have about a 95 minus 74, about a $21 difference, plus the put side is about a $34 credit. So if we drop our fill to around 35, 34, we should get filled. We'll put it at 34 here. We'll go ahead and place order. And immediately we got order filled. And we'll go ahead and check our fill status here and see what we got. Alright, so we did get in that trade. We'll combine these all into an Iron Condor because that's what we're playing. And there you have it. We took in $37 of credit. Alright, stay tuned for the next trade. Alright, last trade we'll be looking at is QQQ. As mentioned before, we're sitting at a 72% IVP. QQQ has about a 400 million float, so it's a little smaller, a little more volatile moves. You can see our 1 year plus or minus max move is about $6.76. So we're going to be looking to do a call spread on this, just based off of it recently, pushing its way up, then starting to come back down. It hit that resistance there. It's in a nice little downtrend. Move this options chain out of the way so you can see this here. Alright, so you can see we're in a nice little downtrend forming with a base of around, about 188 or so, wherever that sits, 187. Coming right down here to the 185 mark. We went up, we tested it, we started flushing back down. We got a downward indication on our pop flop indicator. And there's nothing really indicating that this is going to move back up, and nothing really indicating that it's going to push back down. But being that it had this top side resistance and downtrend starting to form with a downward indication, we're going to be doing a call spread. The call spread we're looking at was earlier we were looking at the 185 and the 185.5. So if we check that out today, see what we got here. We have the 185.5, which is sitting right around 75% probability out the money, and the 185.5, which is sitting right around 80%. That's a $50 credit or spread difference and about a $10 credit. So we'll be looking at about a $40 max risk for a 25% return on our money if everything goes as planned. So we'll go ahead and we'll enter this trade. This is going to be a call spread. We're going to sell the 185, buy the 185.5. And the spread difference here is roughly $11. We're going to try to get filled right around 10. Place order. Yes. And we'll wait to get filled. Alright, so we ended up getting filled. We'll check our manage tab and we got filled with a $10 credit. So $10 credit against a $50 max spread difference here for a $40 max loss with the $10 credit we took in. We'll be looking to take about 25% return on money risk if everything goes as planned. Alright, so those are the trades we're looking at this week. We'll see you when we close these trades out, and we'll see you in a couple of days when we enter into the MU trade for the earnings report coming out that afternoon. We'll see you soon. My name is Chris. Have a good day.